So last quad, you may remember we talked about variance analyses and we looked at the impact on our profit when we sold more or fewer units and how that could vary because strictly due to the number of units we sold or because the cost of the input varied from what was budgeted or the actual amount of input varied from what was budgeted. And we, in the process, looked at the price variances and the efficiency variances. What we didn't do was we didn't dig any deeper into the impact on revenue. We focused predominantly on the expense side. So what I want to do in this video is walk us through how we can analyze our revenue and how that impacted our operating income. And so to do this, I'm going to use this data that we're looking at right here. We're an ice cream store and we sell, for purposes of our example, we sell 3 different kinds of ice cream: mint chocolate chip, vanilla, and rum raisin. From a budgeted perspective, we are budgeting that we will sell all of the ice cream for $9 a pint. But then you'll notice that depending on the flavor, the variable cost per pint changes. And then we have a budgeted contribution margin per pint that's identified here, which is nothing more than the difference between the selling price and the variable cost. And then here are our budgeted volume in sales. So we're anticipating 35,000 pints of mint chocolate chip, 45,000 of vanilla, and 20,000 of rum raisin for a total budgeted sales of 100,000 pints. Now, here's what actually happened. We did indeed end up selling our ice cream for $9 a pint, but our variable cost per pint ended up being a little different, $4.60, $3.25, and $5.15, thus leaving us with a different contribution margin per pint. And then our sales volume ended up being a little different. We sold fewer of mint chocolate chip, more of vanilla, and more of rum raisin to result in a total sales of 12,500 more pints of ice cream than we had budgeted. So what we're going to do first is look at that sales volume variance, the impact on our operating income of selling a different volume than we had originally budgeted. So what you've got here for each of the different flavors of ice cream are the actual quantity we sold, that just pulled from above, and in column C, the budgeted quantity we sold, and then the difference, which is literally one minus the other. Mint chocolate chip, we sold 1,250 fewer than we had planned. Vanilla, we sold 11,250 more than we had budgeted, and then rum raisin, 2,500 more. And then we had the budgeted contribution margin per pint. This information came just from above, the difference between the budgeted selling price and the budgeted variable cost per pint. And so our sales volume variance is the difference between actual quantity and budgeted quantity times the budgeted contribution margin. So this amount is the change in sales strictly because we sold more or fewer than we had planned. And you'll notice for our mint chocolate chip, it was unfavorable, but for vanilla and rum raisin, it was favorable, leaving us with a net $70,000 favorable sales volume variance. Now, the sales volume variance can be further broken down. Notice we have 3 different types of ice cream we're selling. that variance may arise because we literally sold more or fewer units, pints in this case, than we had originally planned, or it may be because the sales mix was different. And those two things are different. We want to look at them differently. And so what we're going to do first is calculate the sales mix variance, which is the variance that arose because the mix between mint chocolate chip, vanilla, and rum raisin was different than what was budgeted. So the way in which we do that is we take the actual amount of units sold in total, which was the 112,500, and then we determine our actual sales mix percentage. So all this is the number of units of mint chocolate chip, for example, that we sold, divided by the grand total of 112,500. So our mint chocolate chip ended up actually being 30% of total sales. Vanilla was 50% of total sales. And rum raisin was 20% of total sales. Okay. Then in the next column, what I've calculated is the budgeted sales mix percentage. Okay, what did we budget that we would sell of each kind? And so for mint chocolate chip, we had budgeted a sale of 35,000 out of a total of 100,000, which would be 35%. Vanilla, we budgeted 45,000 out of 100. And then rum raisin, 20,000 out of 100, or 20%. Then in column E, all I've done is taken the difference. So basically mint chocolate chip, our sales mix percentage was less than budgeted, and vanilla and rum raisin, vanilla was more. Rum raisin, we hit the nail on the head. We sold it, the rum raisin was exactly the same percentage of total sales that we had originally budgeted. Then we're going to take that budgeted contribution margin per unit, which we calculated up here. So we budgeted a contribution margin per unit of $4.20, $5.80, and $4 respectively. And here is the calculation of the sales mix variance. The actual number of units we sold times the difference in sales mix times the budgeted contribution margin per unit. So for mint chocolate chip, it was actually an unfavorable variance. We sold fewer or a lower percentage than we had budgeted. For vanilla, it was actually a favorable sales mix variance. We sold a higher percentage. And then notice the sales mix variance for rum raisin is 0 because we hit the percentage on the head. So with the $23,625 unfavorable variance and a $32,625 favorable variance, we actually still came out ahead. And a lot of that, notice, is because the budgeted contribution margin per unit was higher for the vanilla that we sold more of than it was for the mint chocolate chip that we sold less of. And so that favorable variance absorbed and then some the unfavorable variance for mint chocolate chip. So what we know from this is part of the reason our operating income varied was because the sales mix was different than we had originally planned. Now note that if all three products had the same contribution margin per unit, there would be no sales mix variance. Sales mix only matters when there are different contribution margins for the different products. Then the last breakout that we want to do is the sales quantity variance. This is the variance that arose strictly because we sold 12,500 instead of 100,000. And so to calculate this, we've got the actual total units sold, 112,500, the budgeted total units sold, 100, which is an increase of 12,500. Then we take that, we determine the budgeted sales mix percentage, which we have from above, and then the budgeted contribution margin per unit, which we have from above. And the sales quantity variance is the product of those, the difference in sales times the budgeted sales mix percentage times the $4.20 for the mint chocolate chip. And for each one of these, notice it's going to be favorable because in all instances, well, we sold more. And the quantity or the amount of the favorable variance depends a lot on what the budgeted contribution margin was. So you'll notice vanilla has the highest favorable variance because it had the highest contribution margin and the highest sales mix percentage. And so the end result is that the sales quantity variance is favorable for $61,000. So the way in which we interpret this is our sales revenue increased for $61,000 strictly because we sold more units, and by $9,000 because we sold more of the product that had a higher contribution margin and less of the product that had a lower contribution margin. Now, we can get more information on the sales quantity variance by breaking it further down into market size variance and market share variance. We're not going to do this at this stage, just given everything that's going on and how we need to get through the material. But if you think about it, I want you to at least understand the concept that if our sales go up in quantity, it's either because the size of the market increased, there were more customers out there, or because our share of the market went up. And it's important from a management perspective to understand how much arose from which. If the market size increased, that's great. Then we can address that need. If our share of the market has stayed the same or maybe even gone down, then we need to understand that so that we can think strategically about how we can increase our share of the market. So breaking this down into one more layer, the sales quantity variance is a positive thing to do from a management perspective.